Well, thanks for joining us on BloombergQuint. Now, another strong set of numbers coming in from Bharat Forge quarterly results, which came on Friday. The revenue up 13% at rupees 2,385 crores. Profit almost nearly doubled, beating Bloomberg estimates. To put things into perspective and how things are panning out ahead, joining me is Amit Kalyani. He's the Deputy Managing Director for Bharat Forge. Sir, great to have you with us today.
Hi, Nishan. Thank you. And it's great to be with you.
Talk us about what went in the quarter gone by. What are the key drivers? What are the things which are still lagging?
So in the quarter gone by, I think overall our performance has been pretty satisfactory. We've seen a growth in pretty much almost every sector except the global passenger car sector, where there has been an impact due to the chip shortage. We saw strong recovery in the oil and gas sector, and we expect that this sector will continue to remain strong because of demand, winter coming, as well as increased demand of gas over oil and coal in many of the global markets because of environmental concerns. We also see a strong business development in our electric vehicle supply chain, where we have a strong business already, and this will continue to grow significantly stronger, driven both by the aluminum forging business and by our electric vehicle electronics. This is power electronics, control electronics business also, which is now starting to gain traction. And obviously the Indian recovery and the Indian capex story, which is what everybody expects to start kicking in, coupled with the end of the uncertainty over COVID and resumption of normalcy, will see some amount of sustained growth coming in.
Right. Where are we on the chip shortage? How is that playing a spoilsport for you?
See, what is happening with the chip shortage is there is rationing taking place at every OEM customer. And customers are choosing to build a lower number of vehicles, but those vehicles which give them the highest profit margin. So luckily enough, we are on a lot of those platforms, but volumes are obviously impacted. So Q3, we will see an impact of this, and it's not going to be drastic, but there will be some amount of impact. But the good news is that the end consumer demand is still very, very strong. Whether it's commercial vehicles, whether it's pass car, waiting periods are long, and in fact, it is being reflected by second-hand sales prices going up. And in fact, non-availability of vehicles on sales lots. So undoubtedly, there is plenty of demand. And as and when the chip shortage sorts itself out, it should provide a big stimulus and a big boost to our growth.
Is the worst of the chip shortage over, according to you?
I see the chip shortage has three elements. One is basic chip production. Second is supply chain. And third is some unique components which are not available for 10 to 20% of the vehicles. So, for example, some advanced features such as ADAS, etc., are being left out by many vehicle companies because they're choosing to use chips in getting vehicles out the door rather than fully featured vehicles. So these are the kind of things we are seeing. But the chip shortage is not, we're not out of the woods yet. And I'm not certain when we are going to be out of the woods, but we expect that after December, this situation should start easing.
Right. You also mentioned the result that the auto exports are expected to be impacted going ahead.
Only in the immediate period because of the chip shortage, and not because of any consumer event or any market share or any such related event. In fact, we have tremendous business that is tied up. As I had mentioned, that our aluminum forging business, which will do about close to 70 million this year, we already have capacity in place to take that to well over 250 million. And we have business tied up for even more than that. So that itself should give us plenty of growth in the next 1 to 2 years. Similar situation on our engine and chassis components business out of India. Similarly for transmission components, there's a huge growth of business tied up, which will start ramping up once the pass car production and volumes go up again.
Right. And what about the international business as far as the CV story is concerned? What's happening there?
So on the international CV market, there is very strong demand. In fact, the US demand post the infrastructure spend taking place from next year will also get further sustained. So we expect not only that CV market to grow because of the pent up demand, but also because of the infrastructure spending and because of the increase in a lot of the uh, uh, replacement of fleet, which has become very old, taking place in both US and Europe.
Right. And what about the other?
Nishant, additionally, we expect the construction and mining sector to also have a lot of growth in the US because of the infrastructure bill.
Right. And give a sense of the defense and the EV. How are they panning out in terms of demand as well, especially on the EV sector?
So on the defense side, as you know, we are still waiting for the big orders to take place. Right now, there is a slight lull because of this whole corporatization of the OFBs. So a lot of orders are not being placed. It's a delay taking place, but I think knowing well what's happening in the current environment, this is bound to happen in terms of the growth coming that is just around the corner. In the EV space, we are very well positioned, not only on mechanical components, but on electrical and electronic components and subsystems, where we have built up fairly good capability. This year itself, we should see on the electronics and electrical front a business of about 100 crores or so globally, and this will continue to grow. And we see enough visibility that this can continue to grow at a healthy double-digit margin going forward.
But the demand is picking up definitely, right, for the EV business. At
Absolutely.
what pace are you seeing that? How has things changed in the last 1 year?
The growth here is not going to be measured in terms of percentage. It's going to be as a step function. So I definitely feel that we're at the beginning of this inflection point. Once it comes, there will be very steep growth.
Right. And you expect to maintain this momentum, the growth momentum that you have been seeing, or you expect some headwinds going ahead?
Well, we expect to maintain the growth and in fact hope that we will accelerate this growth going forward, because we have many more products that are coming onto the onto market, and all of them have multiple customers that will be using them. So we see good opportunity for growth.
Right. What do you see? What is your view on the domestic commercial vehicle market? It has been under stress for the last couple of years. Seems to be coming out of the woods.
We see the domestic commercial vehicle market better in Q3 and even better in Q4 based on what our customers are telling me. So I think the domestic market industry, the CV industry in Q4 will be heading back towards on a trajectory to head back towards the high volumes that we saw in 18-19.
Are there any concerns still persisting in the industry that could derail the CV momentum? Because we have done a couple of stories as well. While the demand is coming back in the fleet, the individual owners are still struggling, and the fleet utilization seems to be not going up as well.
Yeah, see, there are several factors which have affected this. Obviously, COVID and the post-COVID impact is going to take some time to play itself out. As gross capital formation starts picking up once again, there is always a lag effect from the time the capital formation starts to the time when actual work starts on the ground. So I think right now people are replacing fleets because of the scrappage policy being coming in place, and because the newer vehicles are required in certain areas where you cannot enter with older vehicles, and also the cost efficiencies. So I think right now it's being driven by regulatory and other factors. Very soon after that, maybe in 6 to 12 months, it will be driven by robust demand factors.
Right. Lastly, on BEML, what is your view on BEML? Are you looking at BEML?
Obviously, we continue to look at opportunities that interest us. BEML is a company that is in multiple areas that are of interest to us. We look at it, but we're in a preliminary stage. The whole process has just about started. So I think we're in early days right now.
And lastly, strategy for acquisitions going ahead. What are you looking at for?
So we have formulated a very clear strategy for acquisitions, and we are going to buy companies in industries and sectors that will complement our overall growth strategy and help us build on that to create more subsystems and solution capability through the synergy of what we do plus what the acquired company does.
In terms of segments, what are your key what are lookouts right now? What demands are you looking at? PVC?
Right now, the companies we're looking at are not in the automotive forging business.
Mm-hmm.
So I think that should give you a sense of what we're looking at. It's more on the non-forging business right now.
Right. Great. Any last words on the outlook for the upcoming quarters we should watch out for?
So basically, I'd like to say that the company is very well positioned both in the marketplace, both in the technology space, on the balance sheet, and you will see us, beginning to start growing significantly faster than the underlying market, driven by our new products and kind of business that we have got tied up already, where a large part of the capex is done.
Right. I think we'll leave
and
that
our
note.
overseas subsidiaries will deliver a double-digit EBITDA margin for the full year.
Great. We'll leave at that note. Mr. Kalyani, thanks for your time. Wishing you all the best for the coming quarters and the year ahead. Thank you so much for staying to BloombergQuint.
Thank you, Nishant. Thank you for your time.